Good morning, good afternoon, good evening, everyone. I'm Hans-Peter Lankes, Managing Director at ODI Global, and welcome you all. Thanks for joining this panel. So as we meet, the COP climate talks are underway. We all know that they're happening in a very complicated geopolitical environment. The United States has stepped back from the talks. It is not participating. China remains committed. It remains committed to its climate talks. It remains committed to the discussions about the BLM package, as it is now going to be called more generally. Even though it has been somewhat hesitant to set out financial commitments within the UN framework, it is expanding its role in practice in global climate finance. Now, in Africa, we're seeing very strong momentum in the energy transition and in renewables investments, and there's a focus on it from various angles. There's the creation of country platforms in various parts of the region that are dedicated to enabling investments into the energy transition. There is the Mission 300 initiative by the World Bank and the African Development Bank, which is now gathering steam with many other financial institutions joining it. The aim being to enable 300 million more Africans to connect to the power network by 2030. We know about South Africa's Just Energy Transition Partnership, and Senegal also has one. So there's a lot going on in Africa right now. And central to that energy transition, those investments in Africa as elsewhere, is Chinese technologies. They have been very central to the shift because China has managed to bring down the cost of those investments enormously over the past couple of decades, as we know, and that has really enabled this technological shift that we're seeing. Now, the question is, what role will China play in the future financing and investment in Africa? Are there others that are stepping up to fill the gap? How is that space developing? So that is what we're going to be exploring today in this seminar. And we will draw on some new research on South Africa and Zambia. And we will hear from experts here on the screen who are going to talk about the opportunities and the challenges in this context. To start with, we have a short presentation from ODI researchers. Well, it was going to be Yunnan Chen and Olena Borodina. Unfortunately, Olena has had a medical emergency and is not going to be able to be with us, but Yunnan Chen is going to be presenting for her and drawing on that recently published research on South Africa and Zambia. So after Yunnan has made this presentation, I will then introduce our panel of experts and we will see them commenting on the wider trends in the African power sector. I would encourage everyone online here to submit questions for the Q&A. Let's make this a nicely interactive session after the first rounds here with the panels. Let me just briefly introduce Yunnan Chen, who is going to lead off on the South African and Zambian experiences. Dr. Yunnan Chen is a research fellow in ODI Global's Development and Public Finance program. She's specializing in the governance of development finance and of sovereign debt, and on the role of China in shaping the global financial architecture. Her expertise spans China's overseas development finance, the Belt and Road Initiative, China-Africa economic relations, and more. And Yunnan has obtained her PhD from the Johns Hopkins School of Advanced International Studies, and she's held fellowships at Boston University's Global Development Policy Center and the Center for Global Development. With that, Yunnan, over to you. Let's hear about South Africa and Zambia. Yunnan, I think you are muted.
I am indeed muted. You would have thought after years of this, we would know better. Okay, just making sure you can all see my slides. Okay, great. And thank you for the introduction and also sending apologies from Elena, my colleague on this project, who's unable to join today. So it will fall to me to discuss both of these case studies. I'm going to kick off the presentation before turning over to our expert panel. And in my presentation, I'm going to briefly outline some of the context of China's overseas energy finance, dive into some of our sort of top line key findings from South Africa and Zambia, and then summarize briefly on some kind of common themes, takeaways, and trends to watch in the region. So just to give a bit of context first, that this project and research is the latest of a series of work at ODI across multiple programs that examines China's evolving engagement with the Global South, looking at the impacts of the Belt and Road Initiative, energy transition, and the role of overseas financing as well from China. We know that China has been a major creditor and a provider of development finance to low and middle income countries, but this is also a model that's been shifting over the last decade or so, where we've seen a diversification in the institutions and instruments of financing away from kind of policy bank driven lending towards more commercial co-financing and risk sharing models. And they've also seen a broader slowdown in financing that's reflecting a more conservative attitude to risk from Chinese banks. At the same time, there's also been a qualitative shift in China's engagement with the Global South. We're seeing, particularly in the post-COVID era, a discursive shift towards a green Belt and Road Initiative, in line with China's own domestic transformation in becoming a leader in some of these low carbon technologies and clean technologies. And increasingly, emerging economies are becoming more critical markets for Chinese overcapacity, essentially, in renewables and clean technology. And Africa has been a major destination and a beneficiary of some of these trends when it comes to Chinese lending and investment. And in this project, we try and zoom into two country cases to see how these macro level trends are playing out on the ground. In these cases, we're asking essentially what role Chinese capital, broadly specified in terms of finance and in technology, what role is this playing to support the energy priorities and energy transitions of these countries, and to examine what are the kind of key barriers and opportunities for investment. These papers draw heavily on direct stakeholder interviews, including with Chinese and international investors in the energy sector, financial institutions, and government representatives. And I want to take this moment also to credit the multiple co-authors and collaborators that were involved in making this possible. Elena Borodina, Nichelle Robb, Celine Sean-Xie, and Wei Shen, who's on the call, in facilitating a lot of these stakeholder interviews and insights. So we look at these two countries, South Africa and Zambia, for multiple reasons. They're distinct cases as both being regional power hubs. They have high renewables potential, as well as quite significant policy ambitions for energy transition and diversification in their own contexts. Both countries also have long-standing and quite deep economic relationships with China. South Africa is the largest recipient of FDI on the continent from China. It's also a member of the BRICS grouping. Zambia is also one of the largest recipients of Chinese official and commercial lending, as well as a destination for major Chinese mining investors. So turning first to South Africa, South Africa has a very complex political economy when it comes to its energy sector, and I think we can say it's faced a broad array of challenges around its energy stability and energy security over the years, manifested in issues around recurring load shedding over the years. It's an economy where coal is still predominant. It's the primary um, uh, source of electricity generation in its energy mix. But South Africa has also pursued very ambitious plans for just energy transition, and has invested massively in renewable energy generation under the REAP program, which leverages private investment under an independent power producer model. And more recently, we've also seen South Africa embark on quite ambitious reforms of its electricity sector and the power utility Eskom through unbundling transmission and distribution, and the creation of a new national transmission company. So this IPP model that we've seen in generation is now also likely to be deployed when it comes to the transmission sector through these independent transmission projects. In terms of its climate finance relationships, South Africa stands out from the rest of sub-Saharan Africa in that it's not been super reliant on international climate finance. In fact, it's the domestic commercial banking sector that has played the dominant role in financing a lot of this renewables deployment under REAP. But of course, as we've mentioned, South Africa has engaged in multiple diverse international partnerships to support its energy transition plans, most notably with the G7 partners through the Just Energy Transition Partnership. And under the Transmission Development Plan, we're also going to see the World Bank stepping in to play a very key role in de-risking transmission sector investments through this newly launched credit guarantee vehicle. So when it comes to China in South Africa's energy transition, China is not a major lender. It does play a key role in terms of Chinese firms as EPC contractors, as OEM equipment suppliers. And this is not just in solar panels or wind turbines, but also in key energy infrastructure equipment, so, in transmission and energy storage, as you'll see in the chart on the bottom right. But despite the importance of Chinese firms, technologies, and also in FDI investment, we see a very limited role for Chinese investors in long-term project investments or in co-financing. We find a few cases of sort of Chinese South African joint investments, including in a wind farm under earlier rounds of REAP and a mining embedded solar project in one case tied to Samancor mine. But there's a clear hesitancy that we get from Chinese investors when it comes to their willingness to take on these long-term projects. One finding from the report is that where Chinese capital does play a key role is in its relationships with South Africa's commercial and financial sector. And this is one example of this is in the very strategic relationship between ICBC and Standard Bank, in which it has a shareholding. Through these commercial banking sector relationships, we see Chinese banks also providing additional liquidity into South Africa's commercial banking sector through on-lending, credit lines, or risk sharing via participation in syndications. And one key area in which I think there is potential to explore is in supporting greater cooperation with South Africa's public development banks as well, such as IDC, in ways that can expand the lending capacity of these public development banks. So there are clear opportunities, I think, in the South African case to leverage greater Chinese capital and investment, and the transmission sector is one where Chinese firms clearly have the expertise, capacity, and some of these key technologies. And it's also an area where we see interest from Chinese firms to participate in some of these ITP, independent transmission project plans. Chinese firms have participated in pre-qualification tenders. And we're going to see a request for proposals later this year for some of these transmission projects in which we're likely to see Chinese participation. Another area is in the strategic procurement of Chinese technologies for some of these critical transition infrastructures, such as transmission. And in that, I think there's also opportunities to develop local value chain integration that can support domestic industries. And finally, in deepening partnerships with South Africa's financial sector, particularly in boosting the capacity of public development banks to play a greater role in supporting some of these industrial strategies and supporting domestic capacity building. But our research also identifies some critical challenges for leveraging Chinese as well as external investment. For Chinese firms in particular, they face distinct barriers to investment, and some of these come from Chinese regulations under SASAC, for example, that require minimum rates of return or that limit their ability to hedge currency and exchange rate risk over long periods. And another challenge is around the barriers Chinese firms face in building local partnerships, and this has been a key frustration for many when it comes to managing South Africa's Black Economic Empowerment Policies, or BEE. And this is an area in which Chinese firms just do not have the same sophistication or experience as other international partners. And more generally, there is a need for longer term financing and longer term maturities of financing that can cover the kind of long term infrastructure investment needs in the energy sector. So moving on to Zambia and the key findings from the Zambia case. Zambia is also a country that's been pursuing ambitions for energy security and diversification. While it has a different energy mix, Zambia is heavily reliant on hydropower and hydro production, but this has also made it quite vulnerable to climate impacts, and as such, energy volatility is a major risk for the country's economic trajectory. We've seen major power outages over the last decade related to droughts. There's still significant energy access gaps. And these issues around energy security are also a key constraint to growth in some critical sectors, including in its mining sector, where Zambia is an important producer of a lot of the critical raw materials important to global energy transitions. We have seen strong ambitions to increase Zambia's installed capacity. The IRP targets 10,000 megawatts of installed capacity by 2030. And we've also seen already some major solar and wind investments in the country, including the Chisamba solar plant. And Zambia has also pursued quite diverse international partnerships with European and MDB partners to finance these investment needs. But when it comes to China, we see a sort of mixed engagement from China and Zambia. China has been an important and major provider of financing to the country, including into the energy sector. And this has been largely through state-backed lending from policy banks and some commercial players, which has gone towards financing a lot of these major hydropower projects as well as some coal. But this has also been quite problematic. It's contributed alongside Zambia's other external and domestic borrowing to growing unsustainable debts, leading to a protracted debt restructuring process since 2020 under the G20 Common Framework. And there are still ongoing debt restructuring negotiations with some of these commercial financiers. And these kind of fiscal constraints has kind of stalled a lot of the potential pipeline projects when it comes to renewables pipelines, including some of the pipeline projects from Chinese renewable investors in the country. And Zambia faces multiple challenges when it comes to scaling up energy investments as well. And this is also not unique necessarily to Chinese investments. These include ongoing regulatory uncertainties, extremely high costs of financing, gaps in grid infrastructure, and also issues around ZESCO, the power utility, which has also been a bottleneck to having the bankable power purchase agreements that are needed for some of these renewable investments. But we do see opportunities and potential via embedded generation models where you have corporate off-takers, for example, in the mining sector. And we're also seeing emerging examples through energy traders such as Africa Green Co, where under a liberalized energy market, you can have these energy traders that serve as an intermediary between power supply and consumer, and in bearing that off-taker risk. And finally, I think Zambia also represents a country where there are clear opportunities to leverage and integrate into some of these Chinese clean tech supply chains, particularly when it comes to critical raw materials. So to quickly try to summarize, I think across both countries, we see similar themes and constraints when it comes to financing energy transition. Financing risks, off-taker risk, grid limitations, and regulatory uncertainty is a common theme. And this is something where, at least in South Africa, grid constraints and that infrastructure gap is being addressed. In South Africa, Chinese players seem to struggle in particular with localization, building a long-term presence, and the requirements around BEE policies. While in Zambia, key barriers include project bankability, the limited balance sheets of the utility, and hydropower-related climate exposure. There is a market that's opening, but there are still weak procurement processes, and debt sustainability means that there's still limited space for expansion of investment. But I think there are some areas to watch that both of these country cases present, both when it comes to the interests of Chinese investment across the continent, as well as more broadly in the energy sector. First is the potential for corporate off-taker models that tie renewables deployment to industrial and mining sectors. And this is something where Chinese investors, in the case of South Africa's Samancor and elsewhere in the continent, this is a model where we've seen interest from Chinese and other private sector investors. Another area to watch is around the growth of these kind of energy traders and energy trading models, which has been another way to get around the issue of off-taker risk when you have a problematic power utility. Three, I think grid infrastructure and its importance is as a critical transition investment is one major takeaway from these case studies. While grid is not considered a sort of traditional investment, climate investment, it's clearly a critical enabler of energy transitions and broader energy security. And the South African case also represents a model of how to potentially finance this. Investment in grid will also be critical to building more regional power trading models that can support cross-border flows and broader energy stability. And finally, I think these cases also raise a question of how to strategically target some of these key technologies that Chinese investors bring, how to target strategic sectors that can support localization of these low carbon supply chains in ways that can foster industrial development at home and support just energy transitions. So I'm going to conclude there and hand over to the panel, but I encourage you all to read the two reports and follow up further. Thank you.
Thank you very much, Yunnan. That was a great overview, and thanks also for taking on the Zambia and Olena's role here today. Just to point out that these two reports are in the chat, the links in the chat, and anyone who wants to take a look, please do. We're now going to turn to our panel, and let me first introduce them, and then I will have sort of questions for each of our panelists. I would encourage everyone to use the Q&A function. Please come in. Again, let's make this very interactive. And Yunnan is, of course, also staying here with us. So questions to the panelists and to Yunnan, we will have enough time to do that afterwards. So let me get to the panelists now. And I'm really delighted to have such an expert panel here with us today. Wei Chen from IDS. Dr. Wei Chen is a research fellow at the Institute of Development Studies, and he's a political economist specializing in China's low-carbon development and global climate governance. He has over a decade of experience in development agencies, development finance agencies in China, and his research explores energy transitions, carbon markets, South-South cooperation in climate and energy sectors. Wei is a lead author for the IPCC's sixth assessment report and has published widely on renewable energy policy and green industrialization in emerging economies. So welcome, Wei Chen.
Thank you.
Nimrod Zalk from UCT. So Dr. Nimrod Zalk is Chief Research Officer for Climate and Economic Development at the Nelson Mandela School of Public Governance at the University of Cape Town in South Africa. Nimrod is a development economist with more than 20 years' experience. He has shaped industrial and trade policy in South Africa. He served as Deputy Director General at the Department of Trade, Industry and Competition. He also served as a non-executive director of the Industrial Development Corporation of South Africa. His work focuses on green industrialization, on development finance, on structural transformation, and Nimrod co-founded the African Program on Rethinking Development Economics. Welcome, Nimrod.
Thank you very much.
Now, Na Ajikai Ajay from UCT. Dr. Na Ajikai Ajay is a consultant at the Power Futures Lab at the University of Cape Town's Graduate School of Business and a senior associate at Sustainable Energy for All. Her work examines Chinese investment in power generation projects across sub-Saharan Africa, with a focus on financing and governance outcomes. She's an admitted attorney of the High Court of South Africa, so brings extensive experience in corporate and commercial law, a different perspective here on these issues, including energy litigation and banking transactions, and has previously worked at leading South African law firms. So welcome, Na Ajikai.
Thank you so much.
And then finally, we have Kuda Ndlukula. You have to tell me if I get this right. So it's actually Kuda Ndlukula. He's executive director of the SADC Center for Renewable Energy and Energy Efficiency. There he leads efforts to promote sustainable energy adoption across Southern Africa. Kuda has over 2 decades in the energy sector. He has held senior roles at IRENA, that's the International Renewable Energy Agency, and at Namibia's Renewable Energy and Energy Efficiency Institute. And he's worked in power utilities and regional energy markets. Kuda is a certified energy manager and auditor and holds an MSc in renewable energy engineering and an MBA, and has authored numerous technical papers on energy systems and policy. So an amazing collection of perspectives that we're going to have here. Welcome, Kuda.
Thank you,
With
Hans.
that, and I'm sorry if I got your last name. It didn't.
No, it's correct.
Pronounce
It's fine.
Anyway,
Yes,
with
you did
that,
well.
over to the panel, and I would like to start with Wei, if I may. So Wei, can you tell us a bit where Africa sits in the strategy of Chinese clean tech suppliers and power sector contractors? What are the key drivers of Chinese investment? What are the barriers? So maybe you could expand a little bit on some of the points, the themes that Yunnan has raised for us before.
Thank you, Hans, again for inviting me for this very interesting panel, and many congratulations on Yunnan for these two reports, and very interesting reads and an important and timely piece of work. Based on the question about Africa's position in Chinese clean technology supplier and more or less like a Chinese companies going out, there's a lot of how to say different understanding that I heard that many people saying that Africa is no longer the most important economically in the political market or continent for China in the diplomatic way, in foreign investment way. But I think the data shows us that it is quite a opposite story, that Africa still plays a very important, significant, but increasingly complex role in Chinese strategy of overseas energy expansion. We just developed a new database. I think from 2022, after COVID, we see that Africa remains as still one of the largest overseas market for Chinese energy contracts, and after Southeast Asia, Middle East, and Central Asia. And if you look at the gap of the contracted capacities in Africa and compared to other regions, the gap is not that big. That we're talking about 30 or 40 gigawatts being contracted in the last few years. So Africa remains as a very attractive, important market for Chinese energy companies. That's for sure. The interesting thing is that many of these contracts are not driven by political support or kind of this type of strong political push by the Chinese government. That's not true, because the opposite is true. Is that the Chinese policy banks, as you now already mentioned, that their lending in Africa is dropping at the same time. So we see this very bizarre scenario when the Chinese official lending is dropping, while at the same time Africa remains as an attractive market for Chinese energy companies. Why is that? Because Africa's tremendous renewable energy endowment, abundant solar and wind resources, for example, and hydro as well, and combined with relatively low labor costs and relatively less competitive market conditions if you compare to the kind of a red hot spaces in Middle East and even in Central Asia. This more or less like still make Africa attractive a place for many Chinese energy companies. But at the same time, the Chinese state policy banks and state financiers are becoming increasingly cautious about high risks, the so-called high risk destinations. So there's some kind of a mixed interest among Chinese stakeholders regarding African energy markets and particularly renewable energy markets. And this is simply because Africa is a challenging market, basically for everyone. And only the most experienced contractors, only the most experienced suppliers that can manage to establish a sustained market presence in this place. For example, such as Power China, CEC, these are the established players that in Africa, operating in Africa for decades. So it is very difficult to imagine these players will withdraw from Africa. But on the contrary, you see many Chinese companies, they have challenges in enter the market. If it's their first time to try test the water in African market, after they try one or two projects, they probably stop if the first one or two projects didn't meet their expectations. For example, if you see Longyuan and other state power, this type of companies, they tried once or twice and didn't continue their investment. So again, I think it's a very mixed picture regarding the attractiveness of African markets to Chinese players. When we look at the key drivers, three factors. First, Chinese firms really enjoy a clear technological and cost advantage in the market. So they use their dominance in the global solar PV and wind turbine value chain, so benefiting from the economies of scale. And that's one of their comparative advantages to explore the market. So they can offer competitive pricing in terms of construction and in terms of equipment as well. They can provide integrated EPC solutions and O&M solutions, as you now already mentioned. And so these are more or less like why their involvement can be very attractive for many African markets. And also they are the political, the strong signals for the African governments to promote clean energy, renewable energies also attract some of the Chinese players as well. So also, Yunnan also mentioned the new opportunities also are there. For example, the niche opportunities around decentralized system, captive power solutions, around the mining and the industrial clusters. These are another kind of drivers for the Chinese companies to try African markets as well. Yeah. For the barrier side, as I said, the main constraint is about the retreat of the state financing. From the China Exim Bank, China Development Banks, and so on. But the real problem is not really the financing and the policy gaps. The real problem is that there is a lack of bankable projects for traditional type of financing. We can unpack that later on. But so the financing will be available if the projects are bankable. So that's the thing. But for Africa, the number of bankable projects is shrinking. And that is the real challenge, I think, not just for the Chinese companies, but for everyone as well. So the risk perception, project viability, that's are the major concerns for Chinese investors. Of course, you can talk about how to boost their confidence in the long run, but there's some structural problems in African markets, such as the off-taker risks, the inefficiency of the utilities. There are temporary ways to get around these problems. But in the long run, we have to face them anyway. So I will stop here. Yeah, thank you.
That's brilliant, Wei. Thank you very much. You've put some very clear items here on the agenda. It's strategically important, the African markets for Chinese firms. They bring a low, I would call it capital cost. They are they're definitely the ones who've driven down the costs of installing equipment and of those equipments, but they are struggling with the cost of capital, which is the financing cost, and that is a major barrier among others. And it's kind of interesting to hear that. Now, let me move to Nimrod. Nimrod. Now, South Africa has been a global leader in the just energy transition. It's hosted the first JETP platform. And it's been much referenced since then. Can you tell us a little bit about the next chapter, how it relates to this whole story that we're discussing here today, where you see a role for international financiers, including Chinese finance, and what are the main investment gaps there? Over to you, Nimrod.
Thanks very much, Hans. Thanks, Yunnan, for the great presentation and the very interesting report. I think I'll probably start off my response by saying, I don't know, but hopefully if I can elaborate on why I don't know, what I don't know, it might be helpful to begin to address the question. So I think the first thing is that both of these reports give a pretty sober assessment of kind of Chinese investment and financing in South Africa, in Zambia. And I think they raise a number of questions. And, as Yunnan was going through the presentation, the one question I guess that was going through my mind is, well, how different, is there something qualitatively different about Chinese financing in the current moment, given this pullback from perhaps a more public development, soft diplomacy kind of emphasis. And given this pullback to quite narrow commercial criteria. So I think the next thing would be that I think the whole question of international financing really needs to be understood in the context of the gap in domestic resource mobilization. Because first prize is always domestic resource mobilization, and at the center of that, I would say, is the currency risk associated with international financing. And although there have been various kind of mechanisms and discussions about how that currency risk might be managed, I don't think that there is a solution emerging either from the kind of Western international financial institutions or necessarily from the Chinese policy banks. I think there are a couple of puzzles for me in this in these reports. I think the one is when Chinese companies, whether private or public, look at the question of risk in African countries, to what extent are they adopting the similar template to the approach that's driven and very dependent on the major ratings agencies? I mean, it'd be very interesting to know, for instance, do Chinese investors rely on on the Standards and Poor's and Moody's and so on of this world, or do they rely on are there distinct Chinese ratings agencies? Is there an application in the risk? Are different country conditions and sector country conditions taken into account, or is it perhaps a bit of a broad brush approach that views Africa uniformly as a risky environment? I mean, there is some evidence that the default rates on renewable projects on the African continent have been amongst the lowest in the world. So it begs the question, why is the cost of finance so high? And I guess my overall takeaway would be that I don't see much of a strategic approach emerging either from the African side or from the Chinese side. I think that it would be extremely naive for African countries like South Africa, like Zambia, to think that the Chinese finance is going to somehow come on more concessional terms out of some kind of South-South solidarity. Whatever the high-level political statements are, that doesn't appear to be manifesting itself, at least at the moment. On the Chinese side, I think it's, particularly as the US withdraws from its engagement with Africa, it would be an ideal opportunity to perhaps rethink this, this shift back to a very strongly commercial model. So I think there's a need for strategizing on both sides, really. And I apologize that I probably haven't answered your question, but I'm not sure that we have an answer to that question, to be honest.
Yes, thank you, Nimrod. You didn't fully answer the question, that's true, but you have put some new dimension on here. In particular, you've sort of unpacked this question of the cost of capital, the cost of financing, and it would be kind of really useful to look at that. The IEA which is sort of one of the very few sources that look at cost of capital across countries and compares that in the energy sector. They show that in a country like South Africa, but also in India, for instance, in Brazil, the cost of capital over the lifetime of an energy project is the majority of the cost. So it goes up to 60% and more of the cost. So it really matters. Whereas in a market like in the EU or in North America, and that cost is a third or less over the lifetime. So it makes a real difference, and that's what we're kind of looking at here. And what's the Chinese angle? Now, with that, I would like to turn to Ajikai. By the way, I've just the Q&A has become active, and I hope, dear panelists, that you're taking a look at the questions to you. Very good questions here. We will come back to that later. So Ajikai, let's turn to you and to Zambia. Now, the country faces a very different financing context. Nimrod referred to the domestic financing that is more difficult in Zambia. Zambia also has had the debt restructuring, the external financing constraints that come with it. Can you tell us a little bit about financing models in such a constrained environment? What is Zambia doing? Zambia has these ambitious plans. How does it deal with that constrained environment?
Thank you. Thanks so much for the question. And just want to first start off by saying thanks to ODI for bringing us together for this panel. I think the country reports have offered really valuable insights. So I also just wanted to congratulate the team that's worked on this. So to the question, I think Zambia is a very useful case because it's trying to expand its energy investments amid a very tight debt situation. And just to, explore this a bit further, I just want to start, by reflecting on China's role within, Zambia's energy space. And then second, by looking at how financing models would need to shift given the debt sustainability challenges that Zambia is experiencing. So looking and focusing first on China, what we see is China has historically shown a high degree of flexibility in financing Zambia's power sector. So Chinese policy banks and state-owned enterprises have been central in developing Zambia's utility-scale hydro and coal power plants. The standard Chinese approach in the region has largely been using engineering, procurement, and construction plus finance model, with policy banks such as China Exim Bank covering about 85% of the EPC costs, and then the host country or government providing the remaining counterpart funding, so about 15%. So what is quite distinctive in Zambia as it relates to Chinese investment is just how flexible Chinese investors have been and how far they've been willing to go to make these projects bankable. So just drawing on a few examples of existing projects, Chinese-supported power projects in Zambia. So in the construction of the Kariba North Bank extension, for example, China Exim provided a loan to ZESCO, but the structure of that loan went beyond, conventional sovereign-backed loan. The loan was secured through receivables from off-takers in the mining sector. So basically, which was a Chinese mining firm. And so basically, what the Chinese actors did is that they used their broader corporate footprint in Zambia to create additional collateral and ring-fence a flow of funds for repayment, thereby ensuring the project's viability and bankability. If we look at the Kafue Gorge Lower hydropower project, one key aspect stands out in that Sino-Hydro, which was the EPC contractor on this project, was partly chosen because it could help the government of Zambia raise finance for its counterpart funding. Another interesting aspect of that project was that the Chinese banks were willing to participate in syndicated loans and transactions alongside regional and commercial lenders, which is not something that's commonly seen in Chinese-supported power projects on the African continent. So again, this shows quite a willingness to adapt, the structure, blend different sources of capital together, and address the host government's equity challenges to achieve financial close. So whilst we have this flexibility that's been shown quite clearly by the Chinese counterparties taking part in Zambia's energy sector, we see that this flexibility does have limits. So there's been a steady trend we've picked up that as Zambia's debt indicators have deteriorated over the years, Chinese lenders have also attached higher risk premiums to these projects. And in some cases, some projects have been cancelled or haven't progressed due to these debt sustainability challenges and issues. So it is consistent with, just wider literature that sustained deterioration of credit worthiness eventually may lead to Chinese lenders pausing or exiting projects. So while we've seen that China has been quite flexible and creative in Zambia, an important outcome is that it's not indifferent to macroeconomic risk, which leads to the second key point, which is in the current phase of where Zambia is in this precarious financial situation as a country, blended finance will have to start playing quite an important role in new investments that are trying to be established. So after the Eurobond default and long debt restructuring processes, Zambia's ability to take on new non-concessional sovereign borrowing is quite restricted, and this directly affects the scope for large-scale Chinese policy banks on the traditional terms that we've seen and that I explained briefly earlier on. So in this environment, the bulk of energy finance will now need to come from some blended packages with grants and concessional financing playing a more leading role. It would also therefore be important for China to continue to flexibly support financing this essential transition for Zambia. And then lastly, Zambia will need to also focus on trying to pivot towards a more market-driven private sector models. We do have IPPs in Zambia, but they are quite limited in number. But it's important that the private sector plays a more leading role to reduce pressure on ZESCO and sovereign lending. Because ZESCO's balance sheets are more constrained and its debt is closely monitored within the debt sustainability framework that's been established, the country will need to continue to create space for investment that doesn't sit directly on sovereign balance sheets. We have seen Zambia has implemented a number of reforms to try and open up the sector more to private participation, including open access frameworks, multi-year tariffs, net metering, etc. And these are very progressive kind of steps that have been taken. But what we would need to see, for example, from the Chinese side, is having China participate more as IPPs in Zambia, similarly to what we've seen in Ghana. It might be a big ask just given that the kind of situations within the two countries are quite different, but a focus more on private sector participation would also be helpful. And then we've also seen a myriad of other financing kind of propositions coming forward in Zambia, not directly focused on China. We've seen capital instruments such as green bonds being issued. We've seen Africa Green Coast model coming through. So there's quite a number of options that we've seen kind of emerging given Zambia's financing position. But yeah, I think there's options, but we also see a lot of kind of development and steps that Zambia is taking to kind of offset this debt sustainability challenge. Thank you.
Thank you, Ajika. That's brilliant. Really, what you put the focus on here is various measures that can be taken to address this problem of the cost of capital, of the risk perceptions. And that's partly to project finance structures that Zambia is experimenting with. It's partly blended finance or sort of structured finance, which involves more concessional sources. Interesting to hear whether Mission 300 can play a role in this context or some other schemes. And then you put the focus on the need for providers to take risks and engage, as you said, IPPs, private sector risk that would have to be taken in that context. So with that, let me just move to our last speaker here, that's Kuda. Kuda, looking at this from a regional perspective, how do these trends reflect what you see at the regional level as a whole? And can you speak a little bit also to regional solutions, regional connectivity, especially in the SADC context? We've already heard reference to that. Is that a way of addressing these risk perceptions? Is it a way of addressing regulatory concerns, financing challenges, etc.? Over to you, Kuda.
Thank you, Hans. And I would like to congratulate, I would like to join my panelists, fellows, to congratulate Yunan and team for an excellent report or reports. I'm not just congratulating them just because others have done so, but because what we are seeing or what is coming out from the two countries, that is South Africa and Zambia, actually closely mirror what is happening at regional level, in terms of the regional dynamics, priorities, and challenges. If you look at it as a region, none of the countries in the region is energy secure, except for Angola, which has got excess power, and so is a little bit from Tanzania and a little bit from Mozambique. But still also these three countries have also challenges in terms of energy access. But we're also seeing that there's a wider also or growing adoption of renewable energy across the countries. There's also a strong focus on decentralized energy solutions. So, and this is a reflection of a broader shift towards cleaner and reliable energy systems, and also trying to address the issues of climate change. And what we see also are these initiatives at national level also align with regional policy frameworks, including the Renewable Energy and Energy Efficient Strategy and Action Plan, as well as SADC Regional Indicative Strategic Development Plan, which, if you look at under Pillar 2, there's a prioritization of infrastructure development in support of regional integration. When you look at the increasing vulnerability of the region, particularly when you look at the droughts that have affected hydropower, mainly in Zambia, Zimbabwe, there's actually a greater need for regional cooperation and collaboration. Regional connectivity presents quite significant opportunities for SADC, particularly at SAP. As I said, we've got 12 countries that in the region, we've got 12 mainland countries, but out of these 12 mainland countries, 3 are not yet interconnected, which is Angola, Malawi, and Tanzania. So a more interconnected regional power system improves reliability by enabling countries to import electricity during shortages and export surplus power, while shared reserves reduce the need for costly backup capacity. We've seen in countries, let's say, such as Malawi, where they've put up an HFO plant as a backup, similarly with Namibia. But if we have increased regional interconnectivity, we can share these resources. Like I said, if you look at Angola, they're sitting at over 2 gigawatts of excess electricity, but because they're not connected to the region, so they cannot supply this power to the rest of the region. So in fact, if you look at regional connectivity, it allows for the development of large-scale renewable energy generation projects that benefit from economies of scale. SAP itself, the Southern African Power Pool, provides a broader and more transparent platform for independent power producers, which also helps to unlock private sector investment. We've seen now that SAP has introduced quite a number of instruments and opportunities in terms of trading. They are now shifting away from or moving more away from bilateral trading to day-ahead market, post-day-ahead market, and other instruments. So in short, we say regional integration enhances renewable energy uptake by enabling countries then to balance, variability solar associated with wind. In fact, now when you look at what are the constraints, these are the constraints, but when you look at what then are the benefits, especially to then address the financial constraints, large-scale projects such as power generation and transmission require long-term capital, which the previous speakers have also alluded to, that there's quite a challenge in mobilizing this. And then there's also quite high perceived political and regulatory risks in these countries. And we see that also, Shane also mentioned the issue of bankable projects, that there's a deficiency of bankable projects. What we are seeing is that there's very limited resources available for early stage project preparation, which means then we have a shortage of projects that feed into the pipeline. I mean, projects that can feed into the pipeline for bankability. So overall, what I would say is that while SADC countries are advancing in important national energy reforms, also looking at the deeper regional integration, the biggest challenge remains is that we need to unlock capital for sustained and secure, affordable energy across the Southern African region. Thank you.
Thank you very much, Kuda. So you put the focus here on the regional connectivity, regional solutions, and it was interesting to hear. And also, you concur with some of the other speakers here about the need for bankable pipelines for projects to be prepared. And somehow you would think that there would be huge opportunity in regional connectivity for high return projects, because such projects would have benefits well beyond themselves, so to speak. They would have very, very high network externalities. And is the question here, why don't we see more effort to create regional connectivity, so connecting Angola to the rest network? Is this a question of policies? Are these technical issues? Are there cost issues? Be interesting to hear a bit from you. Let's turn for a minute, though, to the questions that have been raised. I think some of them have been answered online, but they're also of more general interest. Perhaps Wei, you could come in. George Carew Jones asked this question about bankability. And there was sort of a follow-up question on institutional investors in those energy sectors. Can you comment on those two dimensions, perhaps?
I'm not sure about institutional investors, but let me try to explain the mentality of Chinese financiers and what do we mean by bankability? I think, yeah, I agree with many of you that bankability is a quite bizarre term. It is bizarre because we think the bankers are more or less like the last gatekeepers in terms of risk evaluation. But I've been traveling around African countries to look at those project size at different stages, when they're constructed, when they're commissioned, when they're in operation. I never see a single banker on this project site. Never, ever. I see engineers there, I see ESG officials there, I see managers there, I see African workers there, I see Chinese workers there. I never see any single Chinese financier or financier anywhere on the project site to evaluate the risks. And yet they are the person to say, no, we are not going to support this project. And they do, but they do have these criteria. Understandably, off-taker risks, which means that if they think that the cash flow of the off-takers is not good, for some reasons, but we're not talking about it in the last 2 or 3 years, because we have to estimate their cash flows in the next 10 to 15 years at least to sign a 20-year off-taker agreement, right? To sign a PPA agreement. Nobody said it for sure. And obviously, all these calculations are contingent. And the political risks, again, it's a highly qualitative assessment. It's like, what's the next president look like to support this project? And we're going to talk about not just the one next president. We're talking about 2 or 3 next presidents in the next 15 years, or even more. If one of these presidents didn't like the project, we're going to be in trouble. So many of this assessment is pretty qualitative and do not based on a robust a model as we know it. And then the perception of the investors and the financiers as a group became important. So that's all I can say about whether this bankability assessment makes sense or not. And the other one, I think Yunnan also mentioned briefly, is about this unique situation in Chinese political systems, that in terms of accountability, and previously, I think the situation is very different compared to 20 years ago, when the banks are encouraged to lend more, even in the high-risk countries. But nowadays, the atmosphere has changed, that financiers, particularly state financiers, are not particularly encouraged to lend more. So if there's a bad loans, there will be checks from the party, from the disciplinary committee, and so on. So this kind of unique accountability systems also affect people's perception of risks, because they have some kind of personal stake in making bad decisions. So that's why they're sometimes particularly cautious, particularly when they're dealing with off-takers or sovereignties that do have a default experience. I think that explains their kind of perceptions of bankability issues. Yeah.
Does political risk insurance play any role in the toolkit of Chinese finance?
Yeah, the political risk is pretty much a standard criteria for the financiers to evaluate. But as I said, you can't assess political risk quantitatively.
I mean, insurance. Are there political risk insurance like MIGA provides it?
Yes, Sanusho provides political risks for all the export credit agency, for all the export credit facilities like buyer's credit and the seller's credit as well. For equity investment, Sanusho also provides long-term insurance for political risks only. They don't cover commercial risks for equity investment. Yes, they do have instruments to cover those risks. Yeah.
Ajikai, do you want to take the question on the institutional investors? Does it play a role in, because you were talking us through some of the structuring options. Do institutional investors play a role in that at all? And perhaps Nimrod, you could comment as well.
Yeah, perfect. Thank you. I think my response would be relatively short. In Zambia, we have seen kind of participation of the Development Bank of Southern Africa in some of these loan transactions together with Chinese banks. I think we've seen, I think that would be the key one that I can think of. And so it's not specifically a South African bank, but we have seen, a proliferation of other banks working together. I think maybe I'll hand over to Nimrod as I just reflect on it a bit more, but right now all I can think of is DBSA. Yeah.
Yes, thank you, Ajikai. Nimrod.
Yeah, I mean, I think a few thoughts come to mind. The one would be, what is the new development bank doing, and could it not play a scaled up role, particularly since it's kind of capitalized to lend in domestic currency, as far as I can see, and might joining the NDB be one route to open up more finance. I think again, I don't think anybody's touched on it, but the Chinese role in the debates about the global financial architecture, the credit ratings agencies. I know that the voice has been quite robust. It's certainly coming from certain parts of the Chinese kind of ecosystem, but is that carried through? Is it reflected in the conduct of the policy banks? I think this might be an important issue to pick up on as well. And then, I mean, there's interesting literature that's been coming out recently about how the kind of the exchange rate risk might be dealt with or ameliorated through guarantees of sorts that multilateral development banks and perhaps even large development banks, national development banks operating in multiple countries might take on board. Um, but again, the fairly sober assessment of these two studies suggests to me that perhaps these issues are not really being elevated to much of a strategic level. I hope I'm wrong. Would love some evidence of that.
No, great. Nimrod, the question is, how can one elevate this to a more strategic level? It's such a strategic issue, right? So there are questions, a whole series of questions for Yunnan. Maybe this is the point where you might want to come in, Yunnan. So by Penny, by George Carew Jones, and then Wei, if you could think for a second about Mengdi's questions, follow-up question on risk Chinese.
I also see Kuda has his hand up. Maybe he wants to interject on the previous point.
Oh, sorry, I missed Kuda. Maybe Kuda, do you want to come in first?
Yes.
And then to Yunnan.
Yes, thanks, Hans. Just to add on in terms of institutional investors, maybe just on the point that has been raised by Ajay Kai in terms of development banks, what we see in the region is that almost all development banks are incapacitated to perform their role as development banks. I think they are competing with quite a lot of needs, and the governments themselves have not capacitated these development banks to come in and support energy projects. But a very interesting case that we're seeing now is the role of pension funds. I spoke to, when I was talking to one of the energy ministers in one of the countries, he indicated that one of their national pension fund indicated to him that their best performing asset was their investment in renewable energy. So they invested in a renewable energy project, and it was one of the best performing assets. So we've seen countries such as, for example, Zimbabwe, it had big challenges in accessing finance at international level. They then turned on to their national pension funds to support. We've seen also the government pension fund in Namibia has got quite a huge portfolio of renewable energy projects that it has invested in. And these are non-listed companies that the pension fund is actually invested in. Just wanted to share some thoughts around that. Thank you.
Okay, no, it's a very good point. Yeah, so we've seen estimates that local institutional investors across Africa have assets that are in excess of, I think, $3 trillion. And with very little experience, and countries have generally very little experience with tapping those assets for long-term investments of this sort. Much of that ends up just in financing government. With that, maybe Yunnan will give you a chance, because several questions on tariffs, on project structures, missed opportunities for Chinese, on
I want to come in just very briefly on the institutional investors point as well, because I think this is it's also something that we see in South Africa, where I think PIC, one of the big pension funds as well, state pension funds, also has interest in investing in renewables. But the issue with that, and I think this is also something more common for across the sector for institutional investors, is that their mandate is to be conservative. They will not invest in a renewables project if they can get better returns elsewhere, or if they have to trade off between a renewables project or a real estate investment where there's a much safer or higher rate of return. And so I think this is also an area of work where ODI has also published previously on the role of institutional investors in supporting development finance, that it is very difficult to shift the mandate of these institutions to take on that kind of risk. And I think this ties back into our previous discussion on how can we enable that? How can we support through development finance to bring in and mobilize more of this private capital? On the just on some of these questions, on SASAC, I think there was a question on sort of the barriers and regulatory requirements. And this is just something that comes out from the South Africa report, that SASAC, which is a sort of regulatory body in the Chinese system that oversees state-owned enterprises, their regulations does play a role in kind of contributing to the risk aversion of SOEs when it comes to taking on long-term equity projects. Chinese SOEs don't have the same sort of flexibility. They have to take on a sort of minimum rate of return in order to have that project approved. And there are certain de-risking instruments that are available, and we mentioned already, risk insurance from Sinosure that can cover some aspects of political risk and commercial risk. But when it comes to currency risk, this is still an area where we're really lacking in kind of mechanisms and instruments that can support these very long-term 10-year plus investments, right? Especially if we're talking about an IPP or an ITP with a concession that's up to 20 years. I think that also answers another question. And then on the role of tariffs, this might be something that my colleagues might be better positioned to respond to. But just on the role of tariffs and this factor, how as South Africa, Zambia, other countries liberalize their energy sectors, the pricing of tariffs is going to be extremely important, both politically, right, but also for the commercial viability of some of these investments. The fact of tariffs being too low has been a deterrent particularly for Chinese investors when it comes to South Africa's REAP program. In later rounds, we really see a drop off in interest from Chinese investors, and part of that is because that they perceived that the rate of return was not going to be sufficient and not attractive enough because of the lower rate of tariffs. And tariff pricing is also going to have to take into account a lot of complex costs as well when it comes to pricing in ensuring that it covers not just the cost of generation, but also the capital costs of transmission, of the grid stabilization. So this is something where I think, yeah, I don't have a sort of concrete answer on this, but it's clearly going to be a really important factor in how the financing models for countries in the region develop.
Great, thanks. There was a question on essentially project finance and so project finance technologies and structures. Maybe Ajikai wants to comment on that by anonymous attendee, if you see that question. While you look at it,
Is that in the chat, in the Q&A, or in the chat box?
It's in the Q&A.
Okay.
Open questions. Don't we give a look at it? Let me just mention one thing here, and that's on the institutional investors. It's been sort of an interesting question, risk perceptions, allocations to this, given that there is, in principle, so much money in various institutional investor pots. It's a very relevant question for how to bring down the cost of financing in Africa and elsewhere. And so one thing that is fairly clear from a whole variety of studies, and the South African G20 has sponsored some of those discussions, is that there are enormous risk misperceptions. And we've heard this already here from colleagues as well. And so the issue, in a way, is of pension funds in the UK are very willing to invest in junk bonds, whose performance is definitely worse than the performance of African infrastructure. And you find those kinds of incongruences all over the place. So it's got to do with regulation, it's got to do with sort of behavioral, deep-seated behavioral issues. It's got to do with information. And that's, I think, what, to its credit, the G20 South Africa has put focus on, and is now creating a framework within which the G20 going forward is meant to be addressing these issues. Let's keep our fingers crossed. That's supposed to happen now this week. That this would be adopted by the G20. So that's just on this question of risks and institutional investors. We have 10 minutes, and apart from Ajikai, getting back to you because of your expertise on these structuring issues, on that question by anonymous attendee, I would like to ask all of you to kind of take Maya's in the chat, actually, Maya's question as a prompt for where do you see a sort of political solution to these issues that we have, the challenges that we've raised here. What is it? So Maya says the Americans have stepped back. What about others stepping in? The EU with its programs. We have these Mission 300. We have the Chinese, of course, with all their capacity. What would you recommend to the powers that be that ought to be done? What ought to be the focus in order to address these challenges? So before I go for sort of a final round on that question, let me just get to Ajikai on these questions of project finance structures and the like.
Perfect. Thank you. Thank you, Hans, and thanks, Anonymous, for the question. It's a very interesting one. So I'd say you're correct in terms of China has been more of an FDI partner in terms of manufacturing and, EPC contracting and financing in that regard. But we've seen less Chinese participation in the form of IPPs and ITP models. So in terms of we are seeing more participation, but not to the scale of essentially the state-backed investment. So in terms of IPP models, I can draw off the top of my head about 2 examples, one from Ghana, which wasn't within the renewable energy space, but then also seeing participation, as I think Yunan mentioned, from the South Africa's REAP program. We saw Chinese participation in Zambia's Scaling Solar program, which was essentially implemented by the World Bank, and we saw that IPP participation there. But I think some of the reasons that have been identified for kind of the lower Chinese investment within renewable energy projects and the IPP structures is a number of reasons. So firstly, it's kind of a problem around the whole continent in that many utilities in the region are heavily indebted. And because of this, Chinese investors often prefer undertaking projects where the African host state gives guarantees for the project. On the other side, we see African host states tending to prioritize larger projects, so more utility scale projects, and rarely offering guarantees for kind of smaller renewable energy projects. So this, in a sense, reduces the opportunities for Chinese investors to come in that regard. There's also, a kind of challenge within the Chinese system itself, where we've seen, or research has found that there's kind of a fragmented system governing overseas investment. So developing projects comes at a cost, high coordination costs, and as a result of these costs, larger projects tend to be prioritized within this governance system and tend to get approved more quickly. So these are kind of the 2 major reasons why we've seen not as much participation by Chinese investors in renewable energy projects, and also why we haven't seen so many Chinese IPPs in the region. Specifically as it relates to renewables, but that opportunity is there. And just given how the balance sheets of a lot of utilities are looking and how, debt sustainability challenges are not really unique to Zambia. We will need to, as I mentioned a bit earlier, explore, kind of the models, other models that can support this, such as blended finance models where we have grants being fed in together with private capital to kind of de-risk those sort of investments. We haven't seen that spring up so much as yet with Chinese sector participation, but that is a key kind of model that we need to start looking at and seeing how we can crowd in Chinese investors, because definitely it is a missed opportunity. But also I see, and you've unmuted, so I can pass that over to you if you'd like to add it, but if not, if that was just a mistake, back to you, Hans.
Thank you, Ajikai. Really, really interesting. Now, let me just build on what you said and come back to my question. 1 minute each. The question of what's the solution? What do you recommend if we had sort of access to the relevant authorities here? Where do we put the focus? We have these EU initiatives, the World Bank initiatives, etc. We have the Chinese strategic priority that we've heard about. What should they be focusing on? We have governments, we have regulatory and policy issues, we have the question of risk perceptions. So we have this whole universe, bankable pipelines. We have this whole universe of challenges here. Where to put the focus on? 1 minute each. Let me start with Wei.
Thank you. I'm not sure I have the silver bullets in my pocket, but two things. First, I think many mentioned the geopolitical challenges for the EU to work with China, but I still want to remind everyone, it's like we can talk about blended finance, innovative financial instruments, institutional finance. In the end, you need somebody to develop these projects on the ground.
Mm-hmm.
Yeah, in the end, you need those equipments, solar panels, wind turbines, shipped from somewhere to get it installed and to make sure it's running for the next 20 years. And then if you think that way, I mean, it's inevitable. It is very difficult to imagine that collaboration is potential, in the picture that without any collaboration with the Chinese actors. And to be frankly, from my side, when I talk to the Chinese companies, they're also complaining about high capital costs, because these high capital costs not just deter the bankability of the projects, they are eating the profit margin for the EPC and all the downstream actors as well. So we have a common kind of a lose-lose-lose scenario if we don't work together.
Yeah. Great, thanks. So solid implementation is sort of one.
Yeah, collaboration, solid coordination, and probably led by the host government to think about some collaborative initiatives. That's important.
Thank you, Wei. Excellent. And Nimrod, your 30 seconds.
Yeah, I mean, I think that this whole question of bankability, I think it very much depends on the country and what the priorities should be. I think for countries like South Africa that have relatively large pools of capital and relatively large kind of institutional investors, how to mobilize domestic capital through instruments like tax-free bonds, which I see some former colleague of yours, Samantha Attridge, wrote something about recently. But then the challenges will differ country by country depending on their level of development. Thanks.
Great, excellent. So you two are sort of on the supply of projects side of things, and finance in a way follows the projects. Ajikai.
Thanks, Hans. I think you've really given us the question of a lifetime. But I think it's really, I think echoing the panelists that have spoken before me, I think it's quite a big coordinated effort. You highlighted a number of key areas, around policy and regulation, around planning, around financing, etc. But I think what I'd like to highlight is efforts like Mission 300 from the World Bank and the African Development Bank, which essentially put the focus on governments to identify what their national priorities are, identify their finance needs, and then also work with institutions to provide the experts that are needed. I think one of my panelists mentioned about how governments, as well as other parties within the space, are not capacitated aptly to be able to implement the changes that are needed. So I think essentially cross-functioning support across and through initiatives like Mission 300 are really important to get the financing to where it needs to be, to support developers in building the pipeline, and to support government in terms of regulations, policy, and planning. So yeah, handing over.
Thanks. So it's really a multi-pronged solution that we need to go for here. Kuda, I think we're down to 10 seconds, and then Yunnan, you can close us off. Kuda, please.
Thank you, Hans. I think yes, speakers have spoken about projects, and I assume maybe they're looking at generation projects. But I think as a region, what we now need strongly is the transmission. We need to unlock transmission. So we need to invest so much in transmission. I know the region is working on what you call the Regional Transmission Infrastructure Financing Facility. So I would urge all governments and stakeholders to rally behind this transmission financing infrastructure facility as a conduit with which we can mobilize resources and then invest in transmission. But maybe if you just give me 1 second, the issue of tariffs. I think the tariffs are really, in some countries, are perceived to be very low, in others, very high. I think the issue is affordability is a big challenge in the region. So we are seeing already some, even industries where tariffs are perceived to be low, but because they've just jumped a little bit, companies are closing, they are moving away. Now, can you imagine now a coordinated region with such, with interconnected region where generation is high and then we have more players. So we need stronger coordination so that we are able to reflect that huge investment in generation, so that the competitiveness in generation can translate into lower tariffs. Because usually it's not always the case. Generation can be very competitive in liberalized markets, but that does not translate into lower tariffs to the end consumer. So there's strong need for strong coordination as a region. Thank you.
And energy pricing, the third rail of African politics. But you're right. The politics has to play in here. Affordability is a key concern. Yunnan, you have the final 5 seconds.
Sure, I'll be very brief. I think we've had like a great myriad of very provocative insights across multiple areas, but I would say COP is happening this last few weeks, and we're talking constantly about the need to mobilize climate finance. But in the end, I would concur with my fellow panelists on the importance of building domestic resources and domestic financing. And one way to do that is also through supporting some of these public development banks, strengthening domestic financial sectors, and leveraging institutional investors in the region to support some of these investment needs. And this is an area where we are seeing as well potential from Chinese commercial sector and Chinese financial sectors. One example is, using RMB bond issuances, for example, to access capital at a slightly lower cost. But in the end, I think we cannot rely on international financing, and as we've seen with the US pullout in the last few years, supporting regional development banks, supporting national development banks will be critical. Thank you.
Thank you, Yunnan. Thank you, panel. You've gone way beyond. You have really delivered a lot of great, thoughtful material here for us. We'll have to pull this together somehow, and it should be helping us to think through those problems in the coming weeks and months. Now, thank you, panel. Unfortunately, we're not sitting in a room together, but we have this clapping feature. I think I would like to clap and thank you all very much. I hope to see you around on a screen very soon again. All right. Bye-bye, everyone.
Thank you so much.
Thank you. Bye.
Thank you. Bye
Thank
bye.
you very
you.
much,
Bye-bye.
everybody.
Yeah.